What if the market is flat for the next 20 years? How to Really Invest by Sven Carlin. Welcome back to Strongman Personal Finance. We got to react to this video, and I'm going to teach you a very important lesson about the real power of dollar cost averaging. Because fearmongers like Sven use deceptive logic to make you think that you should basically buy his research. Well, let's go ahead and react to this video. Then I'm going to crush this guy's you-know-whats.
Good day, fellow investors. This was a great comment
And yes, it's at 1.5 speed.
on an old video of mine about how investing in dividends allows for compounding over the long term. And when the market does nothing for 15 years, as it is priced for doing now, then you might want to change your investment strategy into something that works no matter what.
Okay, first of all, I don't understand his obsession with the dividend compounding thing. A dividend is cash leaving the company's balance sheet and going into your pocket. You potentially pay taxes, most likely you pay taxes on that dividend, and then you can take that money, that cash that you received from the company, and either reinvest it or spend it somewhere else. The stock price drops by the amount of the dividend. I've said that 1,000 times. There's nothing about compounding here, okay? What compounds is the company's underlying earnings, the future profits.
Recently discussed stocks at all-time highs, but fundamentals deteriorating. You might want to watch that video. I'll put all the links to videos in the description below. But when you look at the current Shiller price-earnings ratio, we are at the second historical high, and given the data we have shown in this video, the returns, when the Shiller ratio is high, the returns over the next 15 years will be low. You will not double your money in the next 10 to 15 years, which is...
Okay, so he's making some very aggressive statements here, and I'm kind of a soy boy. I don't like aggression. But basically what Sven is saying is he's pointing to very simple metrics that, to some people indicate that the market's overvalued. Let me explain to you 1,000 times. 1,001 times. You cannot predict the future. You do not know the future. The market is pricing in basically the most probable outcome for future performance. The market is smarter than you think. The market is forward-looking. The market having a high PE ratio could be high PE for a good reason. Just because there was a high PE in the past, which resulted in lower returns into the future, does not mean that that's going to happen again. Maybe corporate profits are going to massively skyrocket into the future, and maybe the market's PE is reflecting that. I don't know. But it's not as simple as just looking at past price-to-earnings ratios and just saying, well, guess what? Because the PE in the past was high, and if the PE was high, then the market didn't do that well after the PE was high. Therefore, the market now is just totally different than what it was in the past. And yes, the market is different. Corporations are a lot more profitable now, at least in the United States. Therefore, that means we're in a bubble or we're going to have low expected returns. It's possible. Anything's possible. But it doesn't mean it's guaranteed. It is not that easy.
Is a very low return. And when you compare historical returns, 29, 99, 1965, to the stock market returns, you can see here 25 years of flat, 17 years of flat, 12 years of flat, and...
Okay, here's where the fatal flaw comes in. I'm going to show you something very interesting here. So, when you look at a market that's been flat for 25 years, or 17 years, or 12 years, you might freak out because this could potentially happen, and I am not discounting that. This could happen. It wouldn't bother me in the slightest. It'd bother a lot of you, though. Just because the market is flat, let's look at this 25-year one right here. Just because the market is flat for 25 years does not mean you don't make any money. Because if you're dollar cost averaging, you're buying here, 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 and you can actually make money in a flat market. This assumes that you dump your entire portfolio into the market right here at the very top, and then you don't invest again for the next 25 years. If that's the case, then yes, you basically didn't make any money for 25 years. Okay, but let me show you this really cool thing that I made here. This is really going to impress you, okay? So when I was a financial advisor, I learned a little thing to demonstrate to people. Now, this is a chart that shows the power of dollar cost averaging. You're going to see that the sine wave, that's the price of a stock that we're buying, just any generic stock. And every time you see a red X, that's when we generate. That's when we purchase the stock. Now, on the y-axis here, you can see 5, you can see 10, and you can see 15. 5, 10, 15. We buy consistently. You can see that we're buying consistently every 2 weeks or every month or whatever. The red X indicates that. If it's 15, that means that we're buying the stock at $15 per share. If it's 10, we're buying the stock at $10 per share. And if it's 5, we're buying the stock at $5 per share. We're assuming that we invest $100 at every purchase. So if we start this off and the stock is trading at $10 per share and we buy 10 shares, well, guess what? That equals the $100. We invested $100. The stock price was $10. Therefore, we got 10 shares. If the stock becomes more expensive, it goes up and it's now $15. We take our same $100 because we're buying $100 every 2 weeks or every month or whatever you want to make this. And if the stock's at $15, we get 6.67 shares. And we actually have fractional shares now, so that's actually true. And so on, so on. Now, the cool thing is let's say the stock goes from 15 all the way down to 5. And we go ahead and, do our regular $100 contribution. We get 20 shares, okay? Now, what do you notice? We start at $10 per share, and we end at $10 per share. But we actually made money. The stock is flat over the time of the scenario. But because we were dollar cost averaging and scooping up a ton of shares when the stock was cheap, we actually make money. The total amount we invested is $900. 1, 2, 3, 4, 5, 6, 7, 8, 9. We made 9 $100 purchases. With those purchases, we bought 103.34 shares. Basically 40% of which were down here at the $5 range. That's where we really made our money. The ending price per share is $10, like the beginning price. And the total ending value of our shares is the $10 per share times the number of shares we accumulated, which is a total value of $1,033.40. We have a gain of 14.8% over the time period, and the stock is the same price it was at the beginning. What does this show? In a flat market, which this is, no gains, you can still make money. Dollar cost average. Have faith, okay? Believe in the index Jesus. Let's keep reacting to this stupid video.
Then we had money printing. But if there is no money printing, then the 1.27% dividend yield will not help you much. So how to invest now? If the market is flat for the next 20 years, but also if it isn't flat.
And maybe the dividend yield is low because companies are buying back a lot of shares now. Maybe that's why.
Try to invest in a way that no matter what happens, we do well. Because these cycles are normal for the stock market. You always have to expect ups and downs. And I think nobody expects 20 years of nothing, but that has happened many times in the past and will happen again.
And funny enough, he shows the freaking Dow. Okay, I mean, I know that's just, to illustrate a point, but come on. If you're globally diversified,
it comes to the question,
you'll be fine. Dollar cost average into a global portfolio over your working life, you will be fine. You are inoculated from single stock risk, you're inoculated from single country risk, and you're trusting in efficient markets over your investing lifetime. You will probably pay a very average fair price for the market. That'll be your average cost basis over time.
How to invest, dividends, cash flows, compounding no matter what. That's Warren Buffett's secret. And you will say, Sven, that's boring. Well, here is the answer. Yes, getting rich slowly means getting rich surely. So I want to compound my wealth over time, not take risks that block that compounding. And I want to know that in 10, 20 years, I will be well off. All these S&P 500 stocks only go up. Yes, until those don't.
And he always mentions the S&P 500. The S&P 500 is in my portfolio. I guess if you weighted it, it'd be like half of my portfolio, roughly, something like that. But you can also own small caps in the U.S., small mid caps, micro caps. You could also own international stocks. You don't just have to buy the S&P 500, but he always uses that as his example to prove that instead of buying the S&P 500, instead of buying an index, you should buy his research, okay? It's ridiculous.
Because if you look here, stocks don't go up for 20, 17, 12 years, 22
which I already demonstrated. This is assuming you make one big purchase at the top at the beginning of the flat market. If you're dollar cost averaging, which the vast majority of people do, you get a paycheck, you put it into the market, you're going to be fine.
years, and all is left is the dividend, and we already mentioned there is no dividend at the moment. So let's apply this strategy of investing that we do well no matter what, even if the market is flat for 20 years. Warren Buffett strategy number one, he is heavily invested into 3-month US treasuries, getting 5.37.
Okay, so now he's saying buy treasuries, which, by the way, that's a pre-tax yield. Did you know that you pay federal income tax on treasuries? That's right. If you screw up your taxes, you'll probably do it for state, too. If you don't code your taxes right. But you're paying tax on that. Okay, so your after-tax yield is actually a lot lower than that. And treasuries are very safe. So your expected returns aren't that high. If you're Warren Buffett and you have billions of dollars, okay, yeah, that's great. But you're not Warren Buffett. You got $50K in your 401k. Okay, over the next 30 years, I think owning companies that can grow their profits far into the future is probably superior and has higher expected returns because of the inherent risk than U.S. Treasuries, which, oh, by the way, when they cut rates, are going to cycle over and drop precipitously at some point. The yields are, at least, not the price. Okay? So, basically he talks about how Warren Buffett buys treasuries, blah, 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 blah. What else does he say?
Description below, and we have here a great analysis of charts that you have never saw. This one is the standard chart. Sven, stocks just go up, just put your money in the S&P 500 and forget about everything else, right? However, from the same chart, if we adjust a little bit, July 1952 to July 1982, that's a long period of almost nothing. 64 to 1994, real returns, of course. That's
dollar cost average into a global index. That is your best shot. Especially, now this one, this looks like a bad scenario right here, okay? Maybe you broke even on this, maybe. But with this one, guess what? You actually made a freaking fortune if you were dollar cost average because you were buying all down here. Oh, baby, you were buying all down there. And you made absolute bank. So this is a, 30-year time horizon, okay? That's roughly a working like 40 years, et cetera, et cetera. But even then, if you stay consistent and you dollar cost average and you reinvest your dividends, you're going to be fine. You're going to be immune from stuff like this because you have a global portfolio. And worst case, if you get low returns, that's just how it shook out. Okay? But if the index gets low returns, I guarantee you as a stock picker are going to get even lower returns than the index over 40 years. Okay? Pretty crazy there. Let's see what else he has to say here.
2 years of underperformance of stocks compared to bonds. Here is, again, bonds set to equal stocks in February 1980, showing near equivalent performance over the 40-year period ending 2009. Then there are, of course, severe bond underperformance times, but at completely different valuations.
Okay, so what's the conclusion? I buy bonds? Or maybe I dollar cost average into a global total market portfolio?
Current valuations, we have already explained how it is most likely that real returns will be negative for the coming decade or even two.
And hey, if stock returns are flat, if the S&P 500 is flat for 20 years, that won't bother me. It won't. A lot of you will just drop off of YouTube probably and go back to, I don't know, Mario or something. But I am actually happy to just dollar cost average and acquire more and more and more ownership of the world's future cash flows. That's what investing is. You're buying as much of, I like the world, but if you like to buy U.S. stocks, bro, you're buying more and more partial ownership of every company in the U.S. stock market that's publicly traded. That's how you should think of it. What percentage of the global or U.S. stock market can I own? Because I will be the partial owner of all those companies' future cash flows, and I will be able to live off that potentially in retirement. That's how you should think of this. Okay, don't worry about flat markets. If you guess what, if you're about to retire, okay, maybe you should have some bonds in case there is a flat market. It's possible. Maybe you should have some bonds. But if you're 20, this is meaningless. And there's no actionable evidence here. What do you do from Sven's video? Buy bonds? Buy his course? Come on.
Another alternative to bonds is global markets. If we look at emerging markets in China, for example, the valuations there are half of the US. And I'll give you also some stocks. But before the stocks, yes.
Oh, global markets. There you go. Buy them all. Buy them all. Buy everything. Don't just buy what went up a lot. Buy freaking everything. And you will be okay. You will underperform some country's stock market. It's always gonna be like that. But guess what? You're gonna be fine in the long run, and you're not exposed to one country risk.
US, and I'll give you also some stocks. But before the stocks, yes, investing globally, knowing into what you invest takes time, takes effort. It's not easy to be a contrarian these days, but
it's not hard. There's one ETF out there where you can own the entire world at market cap weights because you believe in efficient markets. And you believe if you dollar cost average over your working life, you're going to get a fair price for all the publicly traded securities in the equity markets around the world. Okay, this is not freaking complicated. Oh, you're so contrarian, you're buying international. Wow. Well, he's probably going mostly into international, which is not good because he's massively overweighting it relative to the global market cap. Not a good idea either. Own them all. That includes the US.
It works better over market cycles. As Warren Buffett focuses on these long-term cycles, many call him crazy, but it works over time. The focus is on dividends, owning businesses, and reinvesting those cash flows. And
you don't need to focus on dividends. Focus on total return.
Getting your returns from the benefits that you gain from owning a business. Imagine there is no stock market. How do you get rewards?
Okay, so that's basically the video. So hopefully I clearly demonstrated that, if you're in a flat market, you can still make a ton of money. If the market sells off for 5 years, 10 years, it won't bother me. Because look what percentage of the globe you can buy. You can scoop up so many shares of VT. It's beautiful. It's awesome, okay? So hopefully you learned something. Max your tax advantage accounts. Buy a globally diversified index fund. And don't forget to buy my book, Stop Being a Broke Loser. It's on Amazon. If you want a personalized video, pay me $50. You can see in the pinned comment. And if you want one-on-one tutoring, I can teach you accounting, not stock investing. I can teach you accounting. It's $75 an hour. And don't forget to join the free Discord. Have a wonderful day. Cheers!